All right, good morning, guys. This is Trades of God Academy, and today we'll be talking about chart basics. So, this is going to be an illustration video on chart basics, what you need to know about the market, what you need to know about candlesticks, the anatomy of candlesticks, and etc. So, it's just a breakdown. It's going to be a very short video. Thank you. Alright, first of all, we need to know what is candlestick anatomy. A candlestick shows price movement with a specific time period. Parts of a candlestick: the open, price, and the close part. So the open price at the start of the period, the close price at the end of the period. So we also have the body, distance between open and close. Then we have the wicks and what we call the wicks or shadows. So the wicks at the downside or the upside, they are those tiny line or you see on your candle on the chart. So the wick shows highest and lowest price reached. Types of candle. The candle, we have the bullish candle, which some people on some accounts, some brokerage account or some trading platform, it's green. And we have the bearish candle, which on some trading platform is red. So the bullish candle close is higher than open. So the close of the bullish candle is always above the previous candle, while the bearish candle close is lower than open. So the close of the bullish candle is always below above the previous candle here. The close of the bearish candle is always below the close of the previous candle. So I have some diagrams that I will show you. All right, you can use this one for example. You can see the green candle and then the red candle. So the green candle is the bullish candle, while the red candle is the bearish candle. So some you can actually customize your candle to have different colors, like different colors. Some use black and red, some use white and black, some use blue, different colors. So it's just showing that okay, the green is for the buyers and the red is for the sellers. So you just have to just know where you are entering your trade, the candle you are looking at first before entering the trade. So bullish and bearish candlesticks. So bullish candlestick, you can see it. You can see the dot, the stick here, a very small stick. That is the wick. Let me see if I can show you guys. This stick here. This is what we call the wick of the candle. So it's also called a shadow. So this is the body of the candle. This is the wick. So if you are in a trade, if you have traded before, or if you are new to forex trading, you always see that the candle or most candles always have wicks with it. The body might be small, then you just see a very long wick. Most times the wick can come only at the downside and sometimes at the upside. So depending on the time frame and the particular candle that you are trading. So this is the open of the price. This is where price opened below, and this is where price closed above. That is to form a bullish candle. While for the bearish part, this is where price opens above, and this is where price closed below. That is to form the bullish candle for the sellers. So once you are trading, you have to know okay, these are the two types of candle that we have. The main two types of candlestick, the green and the red, the bullish and the bearish. So we'll go to time frames. A time frame is how much time one candle represents. So we have the higher time frame and the lower time frame. So the higher time frame has consists of the daily candle, the 4 hour and the weekly. and it shows overall market movement, more reliable structure and less noise. Lower time frames. Lower time frame consists of the 15 minutes, the 5 minutes and the 1 minute. You can say the 30 minutes. So 30 minutes, 15 minutes, 5 minutes. Used for entries and exits. More noise, faster signal. So there's this strategy that we call top-down analysis, whereby you start trading from the higher time frame all the way to the lower time frame. So as a pro trader, a pro tip is for you to always identify direction on the higher time frame and execute on and take your trades on the lower time frame. So if you start by, and most people higher time frame is different. I start from the weekly candle. I go all the way down to the 15 minutes, which is long journey. So most times my trade used to be from the weekly candle just all the way down to the 4 hours or the 1 hour. So that is top down analysis. You start from the higher candle, the higher time frame, go down to the lower time frame to execute your trade. So higher time frames, examples daily, the 4 hour, the weekly. So I have a diagram in the next slide. So this is how it is. This is how the time frames work. So as you can see, this is the 4 hour, this is the 60 minutes, this is the 15 minutes. So you can see the different price movement. On the 4 hour, you can see a clear movement. So it went from 1 to 2 to 3 to 4, 5, 6, ABC. So you can see the clear movement. But when you go down to the 60 minutes, you can see what price is doing here. There is a lot of noise, a lot of noise, a lot of noise, a lot of noise. Then you go down to the 15 minutes, you see that it became worse. So noise are much. So while trading, you start from the 4 hours. You start from the high candlestick, the high time frame, and go all the way down to execute your trade. Because once you start from the higher time frame, you already know where market is moving to and what market is planning on doing. What market is planning on doing on the lower time frame. So you just take your trade gradually. So on every chart in Forex, we have what we call the higher highs and the higher lows. Higher highs and the higher lows. So for the higher highs and the higher lows, it shows that okay, the buyers are in the market. So anytime you have market structure that forms a higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, market buyers are in the market. So we also have what we call the lower low and lower high, lower low, lower high, lower high, lower low, lower high, lower low. It shows that sellers are in the market. So those this is basic market structure knowledge, that which you have to know. So once you are looking at on the uptrend in the market, you already know that okay, you have to identify the higher low, then the higher high, and then the higher low, then the higher high, identify the higher low, then the higher high. Once you are looking at bearish market, you have to identify the lower high, then the lower low, lower high, lower low. That is market structure. You always know where to take trade. Take trade if you look at the market very well. So this diagram shows the higher high and higher low because this is an uptrend market. So you know where to take your trade. This is the lower lows and lower high. So as you can see the LH is the lower high and the LL is the lower low. So you see where the way the market is moving. There is a predestined structure for the market. So you can see It's forming a certain pattern always. So support and resistance. Support, price level where buying pressure is strong, price tends to bounce upward. While resistance, price level where selling pressure is strong, price tends to reject downward. So how to draw them? Use previous highs and lows. Mark areas where price reacted multiple times. Think zone, not exact lines. So also key concept. Old resistance can become new support, and old support can become new resistance. So let me show you from the diagram. So as you can see, the upper line up, we have the resistance level and we have the support level. So you can see what the market did. To identify your support, you need to have more than multiple rejection at the downside. So a particular line, you see multiple rejection there. Let me show you. You can see multiple rejection from this zone. This shows that okay, there is a support here. You can see multiple rejection from this zone. While on the resistance part, you can see multiple rejection on this zone. This shows that there is a resistance there. And to draw your support and resistance, you can either draw it on, you can use the high time frame to draw your support and resistance, and also you can use the lower time frame. So anywhere you just see multiple rejections at the downside, you see multiple rejection, then you can use your line to trace it, draw a straight line there. That is where your support is. And also for the upside, you see a line, then you draw it, and you have the multiple rejection at the upside. That is your resistance. So as we have it here, you can see that this is an example where re- the resistance turned to a support. So you can see what market did. It initially went up, went down, went up, went down, maintained this line, this resistance line, and this support. Then we had strong push to the upside, and this is what happened here. It broke the resistance and came back down to use the resistance as support. So this is a buy entry. So anytime you see market move like this, you have, that is to show that okay, the buyers are in the market. To break and retest, then you have this push to the top. So these are things that you have to take note as a trader, because it happens every time in the market. So this is another example of a resistance becoming a support and the market forming a new resistance. So as you can see here, market is has rejected on this place 3 times, multiple times. That is to form a support. You draw your line. As you can see here, market rejected here multiple times. You draw your line, which is a resistance. So if market rejects multiple times at the upside, is a resistance. If market rejects multiple times at the downside, is support. So for me, I will tell you the best time frame to draw your support and resistance. You can start from the 1 hour, but the lowest you should use your 15 minutes, because if you go lower to the 5 minutes, I think there's more noise there, and it might not really be a very very strong support or resistance. So as you can see here, market broke from this place, then retest at this place to form use the resistance as base, then now it's pushed higher. It came formed a new rejection from up, came back down here, used the support, which was the previous resistance, as base again. Show that okay, the buyers are really in the market, then pushed to the top. It came back down. This is just market structure. This is what market does. Always moving up, always moving down, always moving up, always moving down. So this is something that you need to take note of. So a trend line. A trend line connects price swings to show direction. So we have what we call the uptrend and we have what we call the downtrend. So I'm a trend line trader. So I trade with trend lines and fair value gaps and break of structure and the rest. So those are just normal market structure which you have to know. So uptrend. The uptrend is drawn by connect. Hey, stop. The uptrend is drawn by connecting higher lows, acts as dynamic support, and the downtrend is drawn by connecting lower lows, act as dynamic resistance. Rules for good morning. Rules for valid trend lines. You need to have at least, so the same rule applies to the support and resistance. You need to have at least two or more touch points. Don't force the line. Break of trend line may signal trend weakness or reversal. So this is an example of an uptrend. So as you can see, the market retested here, then it did the same here. You draw your trend line to the upside. So what is going to happen here is that market now will come back down and tap on it and then maintain the push upward. But if it breaks down below, it signals that okay, the buyers are losing control of the market and the sellers are coming in. So this is just basic knowledge. And the more you study, the more you find out that all these things are easy. So on this diagram, you have the uptrend with the blue, you have the downtrend, and you have the sideways trend. So the sideways trend is also called the choppy market. We don't trade the choppy market because then there's indecision in the market. The buyers and sellers do not know what to do yet. So you trade only when there's volume and when there's a clear signal. So on the uptrend, you can see the low, you can see the low, you can see the higher low, you can see the higher high, you can see the higher high, you can see the higher low. So this is what makes an uptrend. There should always be a low. It should be like a a staircase going up, and for the downtrend, it should be like a staircase coming down. So there should always be a low for the uptrend before a higher high, then a higher low, then a higher high, then a higher low, then a higher high. While for the downtrend, there's always a high, then a lower high, then a lower low, then a lower high, then a lower low. So that is how you identify the uptrend and downtrend. So the summary for the class: candlesticks show price behavior. The higher time frame gives direction, lower time frame gives entries. Identify bullish or bearish structure, support and resistance, key reaction zones, trend lines help define trend, direction, and entries. So these are what you should note before taking any trade. So if you are analyzing, if you decide, you have to always embed the top-down analysis in your trading, and also always watch the market structure, what market does, and what you should look out for. Thank you so much for joining the class.